Steve Forbes. You're watching Traders Nation.
Welcome back. You are tuned in to Traders Nation. Thanks for staying with us. My pleasure to have with us here today Eddie Ghabour, co-owner of Key Advisors Group. Eddie, welcome to Traders Nation. How are you today?
I'm fantastic. Thanks for having me.
You're more than welcome. Thanks for being with us. All right, so you're pretty bullish. I am too. What's as far as the longest expansion in history, what fundamentals you feel are going to be pushing that, Eddie?
So, I mean, if you take a look as an investor, forget about where we've gone from a market. I think too many people are focusing on that, and it's scaring them to think that this bull market's going to be a bubble. And, bull markets don't die of old age. So when you look at the fundamentals, you have low interest rates. You have 2 consecutive quarters of 3% GDP.
Sure.
You have wage growth pressure that is going to start to happen.
Yeah.
And you have the overseas markets and economies coming out of a recession. And so you have the global economy clicking on all cylinders, and add an infusion of cash from the tax reform that we just saw in December.
Sure.
And to me, it's just a almost perfect. There's no such thing as perfect, but it's as close to perfect as an investment scenario that anyone
Sure.
would want to be in. If you're not bullish in this environment,
Yeah.
I don't know what you would be looking for.
It makes you wonder because there are some folks out there, they seem like they're a little contrarian, and I don't know, maybe that's just skepticism. Certainly, everyone talks about the highs. You don't know where it's going to go, and even if there is a retracement, is it healthy? Of course, right? But like you said, everything is on all cylinders. All cylinders. What could possibly get in the way? And then there's been some talk in regards to maybe the feds come in and they start increasing rates. Do you think that may hinder this freight train that's steaming along at full speed, or no?
Well, here's the thing, and this is kind of I find it comical when people use that. So if you debate a bear, they'll talk about the Fed's going to raise rates 3 times.
Right.
Well, when you're raising rates from 0%,
yeah,
raising rates 3, 4, 5, 8 times is not impactful as if you're raising rates from 8% and taking quarter-point jumps.
Sure.
I think a slow rising interest rate market environment is actually another strong fundamental bullish sign for the market.
Yeah. Yeah. All right. So I'm with you. And again, there's people that they're pessimistic. They think that the raising of those rates will get in the way. And I can agree more. I mean, when you're at 0, and historically, let's quantitative easing for how many years at 0%, it's going to happen. Those rates are going to come up. But I don't think that everything else that we've been discussing so far, I don't think it's going to be even affected. Okay.
No, because here's the thing. The Fed only affects the short-term rates. The biggest impact on the market is the 10-year Treasury, not the overnight lending rate.
Yeah.
The 10-year Treasury note has not even touched 3%. And even if it hits 3%, which is a significant move, and I would expect to see that happen in the next 12 months, it still is not a bearish sign for the equity markets.
Okay. All right. So since Trump took office, I mean, there's been this sense of optimism that really has gone across the land. Coast to coast, and folks are starting to spend a little bit more again. They feel that. And like you mentioned, with the tax reform, people are going to keep a little bit more money in their pockets, which means that certainly as consumers they'll probably end up spending that. I like to see them save it a little, but this optimism that's going to be out there, are we getting back into a consumer economy, Eddie?
Yeah, and that again, another sign. So when's the last time we're at multi-year highs in consumer confidence?
Yeah.
When a tax cut happens, when you have a confident consumer, they're going to spend that money, and we are a consumer-driven economy. And then when you have things like, J.P. Morgan announced today they're going to put 400 new branches in place and raise wages due to the tax reform. Apple made a big announcement last week of repatriating some cash here to the U.S. If corporate America starts to follow JP and Apple's lead, you're talking about a cash infusion. It's a stimulus, but it's coming from a different form than what happened during the recession.
Sure.
And so when you give an economy stimulus when it doesn't really need stimulus per se, that's like adding fuel to a fire. And it's going to blow through the averages, in my opinion, and eventually it will end and we will have a correction. But there's still a lot of cash on the sidelines, and a lot of investors haven't participated in this. And it's a typical psychological late cycle that will happen where they will start to put money in But we're still a little ways from that.
Yeah, quick note on that. I mean, the last administration considered to have stimulus out there, but it was government stimulus. Didn't affect everybody going around. In fact, we had stagnation. We're looking at trillions of dollars coming back into the U.S. markets. Businesses are going to be experiencing growth, certainly. They want to spend that money. They've been waiting for the cue, really, haven't they, for expansion, for growth, for hiring, for equipment, all those things. Eddie?
They have, and I think, one big indicator to this is if you look at the banks. I mean, the banks have really not had as much participation in these markets as other sectors have. And now these banks are starting to come out with record numbers of cash, talking about stock buybacks, increasing dividends, increasing wages for their employees. And I think you're going to really start to see that sector potentially really take off. And that's a really good sign for our economy.
Yeah. Do you think with the banks, the banks may ease up their lending practices like they had? I don't want to say like they had before, because certainly that caused a lot of problems, especially in the housing. But do you think with this static that's in the air, do you think banks may ease those lending practices up, make it a little bit easier to lend that money to small business, maybe even to individuals?
I've talked to a couple of folks that work here in local banks that I deal with, and that seems to be where they're heading. They feel more confident. Confidence will allow you to take a little bit more risk than where you were.
Sure.
They held on to cash for quite a long time to stay capitalized because of concerns of uncertainty and what direction the economy was going to go. But as you see the global markets and global economy expand, if they want to stay ahead of the curve and beat their competition, I think you'll find them become more aggressive in that area, but not giving away money like what happened that got us into trouble in 2007. Something within reason. They went from one extreme to another.
I totally agree, and I think they're going to, if they come back, I think maybe they'll come back halfway, because back then, literally, I got a loan over the phone. I was looking for a vacation property, and my bank, I won't say who they were at the time, said, Mr. Shimmers, no problem, your loan's approved. And I says, well, wait a minute, I just called just to get some information, right? I did
the same thing. They called it a no-doc loan. You could have made up that information. They didn't need any supporting documentation. So
it didn't matter. They had my income. They had my credit score, which is 800 plus. And, and they said, Mr. Shimmers, you're approved already. And I'm going, what? Where's the paper? Right, Eddie?
Yeah, and then they went to the far extreme on the other side. They need to be somewhere in the middle on that.
Yeah, I totally agree. All right, so we're running out of time here. Tax reform and business growth. So certainly I want to talk about jobs. Unemployment rates, fantastic. People are going back to work. In fact, the unemployment rate's so low. If you're not working, it almost makes you wonder if you really want to work. That's how low it is. Your thoughts?
Yeah, it's low. I basically say we're at full employment right now, when you look at how low the unemployment numbers are. And so what's the next cycle that's going to happen when you have the unemployment compress is you'll start to see wage growth. And wage growth is something that the middle class has been needing for a long time because it's been pretty stagnant.
Sure.
And that is going to be another cash infusion into the economy when you start to see wage growth. So, because it's been a long time since we've seen it, and I think we will start to see it as we go into the second half of this year.
I tell you what, it's like opening up a window and getting that fresh air in. It really is. People have just been stagnated for so long. All right, so Eddie, we're out of time. Certainly, where can we find you? You got a website? What's going on?
Yes, best way to find us is KeyAdvisorsGroupLLC.com.
All right, head on over there, folks. Eddie Ghabour with us here today. Head on over to Eddie's website, get some great information. Contact Eddie, employ Eddie, all that good stuff. All right, so Eddie, thanks for your time here today on Traders Nation.
Thank you.
You bet. All right, we'll be right back. Stay tuned.